Hey everyone, let's talk about another fun tax topic, whether or not Social Security is taxable. This video is mainly about the taxability of Social Security at the federal level, but I'll first touch on the state income tax treatment of Social Security. There are roughly 40 states, I want to say 38 to be exact, that don't tax Social Security income at all. Now, some of those states are states like Florida or Texas that don't have income tax, but even those that do, such as my state of New Jersey, it specifically excludes Social Security from being taxable on the state income tax return. So if your chances are Social Security is not going to be taxable at the state level for you because, again, in 40 states, it's not at all. Even in the 10 or 12 states that might tax Social Security, it really all depends based on the rest of your other income, any exemptions or deductions you may get, et cetera. So I can't say exactly whether it is or it isn't. You have to figure that out on your own with your state, but chances are not taxable at the state level. Federally, very different story. And the answer is it all depends. So ultimately, anywhere from 0 to 85% of your gross Social Security benefits might be included as taxable on your tax return. So what do I mean by gross? That simply means the amount of benefits you get before any deductions from Medicare or income tax withholdings. So if you get, let's say, $20,000 of gross Social Security benefits before Medicare is taken out, before taxes are taken out, that's the gross amount we're talking about. Stepping back, there's this measure of something called combined income or provisional income, same terms, that you need to figure out to as a starting process for determining how much of your Social Security is taxable. Now, this combined or provisional income measure isn't used anywhere else in the tax code, to my knowledge, outside of being one of the inputs into determining how much Social Security might be taxable. So let's take a quick look at what that is. The combined income is simply half of your gross Social Security amount plus all other sources of your gross income for the year, such as pensions, annuities, dividends, interest, etc., plus even non-taxable interest income, such as if you have municipal bonds owned in a regular brokerage account, the interest on those is normally tax-free at the federal level. But for purposes of this combined income formula, you would need to also add in that amount of interest to half your Social Security and your other sources of gross income. That's in total, add those up, that's your combined income. So with that combined income figure in hand, what do you now do? That's not the amount of your taxable income. Again, that's just its own sort of little sidebar measure you first have to do in determining how much Social Security is taxable. With that combined income figure in hand, you now have to look at a few different special income brackets. Let's take a look. Depending on your filing status, so if you're single, head of household, qualifying widower, or married filing separate, if you lived apart from your spouse the whole year, this would be your the brackets you would use in determining in looking at your combined income. So if your combined income is below $25,000, none of your Social Security will be taxable. If your combined income is between $25,000 and $34,000, up to 50% of your Social Security may be taxable. Now, notice it says up to. It's not 50% will be taxable. It's up to. So anywhere from 0 to 50 could be 1, could be 12, could be 37% of your Social Security may be taxable. The specific formula to figure out what that exact percentage is way beyond the scope of this video. It's super convoluted and clunky. If you want to see it in detail, you can check out the instructions to the Form 1040 tax return. There's a page-long worksheet in there that grinds through this formula. In reality, just use tax prep software to do your return. Any software is going to do this calculation quickly, easily, and accurately instead of you having to fumble through it. But if you want to see it all spelled out, check out, again, the Form 1040 tax return instructions. You'll see the worksheet there to figure this out. So anyway, so it's up to 50%. It's not none is taxable or 50% is taxable. It's somewhere from 0 to 50. Let's keep going. And then finally, if your combined income for this single head of household, qualifying widower, or married filing separate filing status, if your combined income is above $34,000, up to 85% of your gross Social Security benefits might be taxable at the federal level. And if you're married filing joint, you can see there's 3 different brackets here. Combined income, this is you and your spouse combined. So if you both receiving Social Security, you would take half of both of your Social Securities and all of your adjusted gross income combined and your non-interest income combined. If your combined income is below $32,000, none of either of your Social Security benefits are taxable. Between $32,000 and $44,000, up to 50% of your benefits are taxable. And beyond $44,000 of combined income, up to 85% of your and your spouse's Social Security benefits may be taxable. So it's important to know that just because there's a difference between up to, or there's a difference between 85% taxable and 85% tax. Very different things. 85% tax means of your benefit, 85% of it's taken for tax. That's not the case here. If 85% of your benefit's taxable, that would mean, for example, if you get $10,000 of gross benefit and 85% of it's taxable, it means only 8,500 of it is actually included in your tax return. Then it's subject to whatever your tax rate is for the year based on the rest of your income and your brackets, et cetera. So 85% taxable or 50% taxable is very different from an 85% tax or 50% tax. Keep that in mind. All right, that's it. I'll wrap it here. Hopefully you found this helpful.